Today we're going to talk about the Offer in Compromise program, sometimes known as the OIC, Offer in Compromise. Pretty cool, huh? Essentially, there's three types of Offer in Compromise. The Offer in Compromise program, let me go ahead and explain what it is. It is a procedure, a program set up by Congress to allow taxpayers to settle for less. Now, the IRS lately has been pretty aggravated by people advertising pennies on the dollar settlements, so I'm not going to say that you can settle for pennies on the dollar. Sometimes it's a lot of pennies on the dollar, and offers are certainly not appropriate for every case. There are a lot of big firms in this country who advertise on television, cable TV, satellite, that kind of thing, who point their fingers at the camera and stuff and say that they can settle for less guaranteed. That's not accurate. That's not true. Anyone who tells you that they can settle for less guaranteed, they can get your offer through guaranteed, is not being honest with you. If you look at that guarantee, basically what it says is, we'll fill out the paperwork right. Well, I can guarantee you that at my firm, we'll fill out the paperwork right. If we don't, and sometimes there are mistakes, omissions, things like that, we'll fix it. Not a problem. So the Offer in Compromise program is essentially set up to allow you to settle for less. It's a mathematical calculation. It's based upon your monthly income, your monthly allowable expenses, and your assets. It's essentially a mathematical equation. So it depends upon how much monthly disposable income and your assets that you have left over will determine how much your offer amount is for. There's three types of offers. There's what's known as a cash offer, a short-term deferred offer, and a long-term deferred offer, and I'll go ahead and explain what all those are. A cash offer is an offer which is payable out over a 5-month period. It's basically, it used to be a 90-day period. The IRS has graciously extended it to 5 months lately. It doesn't have to be in a lump sum anymore. It can be paid out over 5 monthly installments. Essentially, the equation to determine how much your offer will be for a cash offer is this: monthly disposable income multiplied by 48 plus your assets, the quick sale value of your assets, which I don't have time to go into, but plus your assets equals the amount of your offer. Let me give you a hypothetical. If you had monthly disposable income in the amount of $50 and you multiplied that by 48 and you had zero assets, that's $2,400. You could settle your case for $2,400 hypothetically. Doesn't matter how much money you owe the IRS. If it's $24,000 or $240,000, you could settle it for $2,400. I've done it. It doesn't matter how much you owe. It's based upon your ability to pay, not how much you owe. The second type of offer is what's known as a short-term deferred offer. Essentially, you can make your the payment has to be made in up to 24 monthly installments. It's essentially a little bit of a different calculation. It's monthly disposable income times 60 plus your assets equals your total amount that you'd pay in a short-term deferred offer divided by 24 payments. So let me give you a hypothetical. $50 monthly disposable income multiplied by 60, zero assets, that's $3,000. Divided by 24 months is $125. I don't understand how, if all you have left over is $50 a month, that you can pay $125. It's never made a lot of sense to me, but I guess what it is you can get that money from friends or family, but you just can't get a lump sum from them. As you can tell, you pay a premium for that short-term deferred offer because the multiplier is 60 instead of 48. Lastly, there is what is known as a long-term deferred offer, and that's your payments will be spread out over the number of months left on the collection statute of limitations. That's why I've posted these posts in this order, because we told you what the collection statute was last time. Basically, to recap that, there is 10 years left on. There's 10 years in a collection statute of limitations. It's 10 years from the date of assessment of the tax that the IRS has to collect it for. So if you had 10 years left on your collection statute and you made an offer in compromise, let me give you this example. $50 times 120 months, or 10 years left on the collection statute, equals $6,000. Now, the cool thing about a long-term deferred offer is it's still $50 a month times 10 years worth of months, so 120 months, and you would pay off your offer. It's a really long time to make your payments on time, but there are people that can do it. So that is another option. If that 120 months gets down to less than 48 months, then a long-term deferred offer becomes the default cash offer. So if you only had 32 months left, for example, then your multiplier would go monthly disposable income times 32 months. Don't want to get too technical here. I wanted you to kind of know there's three types of offers in compromise that are available to you. Some of them involve lump sums, and some of them involve monthly payments for extended periods. That's it for now. Thanks for tuning in.